Good evening. Good evening, everyone. I am CA Rahul Darne, moderator of this webinar. We are delighted to welcome you all in the webinar being organized by the CP Committee of ICAI. It's my pleasure to be a moderator for this webinar on risk management in capital markets and recent case laws in arbitration. In a short while, we will start with this webinar. First, I would like to appraise about CPE committee. The role of chartered accountant is evolving continuously to accept newer responsibilities in a dynamic global environment. The future of CA profession depends on being flexible and open to innovation. Therefore, the need of the hour is to innovate as per the requisites of the contemporary business environment and accordingly upgrade the curriculum and education system of CA course. The committee also believes that members of ICI should look beyond the traditional areas of practice and explore new areas of business and profession, and hence the CP committee is mentoring the members by providing guidance through various workshops, seminars, national conferences, background materials, etc. And simultaneously by encouraging young and dynamic professionals to grow as speaker or master of ceremonies in CPE programs. The program of this evening is as follows. We have two sessions of 1 hour each, and topics are: first is risk management in capital markets, and second program is recent case laws in arbitration. Our eminent speaker will talk about above mentioned two emerging areas of professional interest. So I'll first introduce CA Bharat Makkar sir. He has completed advanced management program in financial services and capital markets from IIM Lucknow, specialized in equity markets and technical analysis of charts, and owns a franchisee and which provides comprehensive financial solutions like investment advice, portfolio management to diverse clientele. He has been a speaker on the topics how to maximize wealth through capital markets, technical analysis masterclass, and strategies in equity markets. Now I request CA Bharat sir to deliver his speech on his today's topic in risk management in capital markets. Over to Bharat sir. Sir, you are on mute. Please unmute yourself. Bharat sir.
Thank you, Rahul sir. Thank you for the introduction. I'm CA Bharat Makkar, and qualified chartered accountant, and in the practice of financial markets, equity and derivatives trading and analysis. And first of all, I would like to thank Tiwari sir, Ajit Nath Tiwari ji also, and the committee, CPE committee, for giving me this opportunity to present before you the most hot areas after COVID. Sir, am I audible?
You're quite audible, sir.
Thank you. So, thanks to that committee, Ajit sir, Rahul sir, for this invitation. So we will not waste more of the time, and we will start our topic today, that is the risk management in equity markets, physically capital markets. So capital markets, I would So today's discussion will include the introduction to money. First of all, what is money? Because we see that there is a lot of risk in capital markets, and risk is directly related to money. There is always a financial risk. Equity markets, mein. there is always a financial risk. So first of all, we will get to know what is money. Second, the journey of stock market. We will take a small route from where market started and where it is now. Right. So third thing is risk management. There may be many participants in the markets. Like some may be investors, some may be traders, some may be intraday traders, some may be long-term investors, some may be short-term traders. So a market is consist of all the participants. So we are here to see that their risk is already different altogether. Investor have a different risk, trader has a different risk. So we will consider the role of trader and investor as well in risk management. And last but not the least, the main topic, risk management strategies, how to manage the risk, how to minimize the risk and maximize the gain. That is the all objective of the equity markets. And for every investor and trader, it is very important to save their capital first of all, and then profits will come on their own. So today's discussion is all about these. So I will start with money. What is money? Money is basically a purchasing power. You can buy anything that is available for sale, right? With money. So equity markets, we have seen after COVID, it has given a uh, huge bull run rallies in the market, which has created awareness in all over India. And already international investors are already investing, but Indian investors have made a great contribution, mostly after COVID. So they are coming 1000 CR per month. So it is going to the retail investors also. So market reach is expanding day by day. We have doubled our demat accounts in last 2 years. So it is very important not just to participate in the markets, but to avoid some risk, so that we should we should be gaining from the markets rather than losing. As per SEBI reports, in last few months, SEBI has reported again and again that in futures and options, 90% of the traders lose their money, and only 10% they gain the money, they gain the profits. So why 90 are losing? The main reason is not a good risk management. So we will talk about this also, how to manage your risk in equity markets. So money, we can say money is like a fire. So you have to save your money in capital markets, which you have deployed. How you will manage your risk? Money is like a fire. See, if a fire, we can cook food with fire also, and when fire is uncontrollable, it can destroy everything. So we have to keep our money like that, in control, like a fire. So if it is being in control, it is kept in control, then it will be a good servant of us. But if mismanaged, it can do blunders, right? So money is very basic principle uh, that we should keep in mind while investing in the markets. So the journey of stock markets, the journey of stock market the Nifty 50. Nifty 50 in 1995, it started from 1000 rupees, 1000 points. That was the basic in 1995. NSE, I'm talking about. So Nifty 50, I will describe in a few lines. Nifty 50 is a stock index which which defines where the market is headed. If Nifty 50, in Nifty 50, there are 50 stocks. Uh, Blue chip company, we say them blue chip companies. So these 50 stocks define the markets, where the markets are heading. If most of the 50 stocks are positive from last session, from last day, then we will see the markets are going good, markets are bullish. If these 50 stocks, majorly stocks are down, then we see the markets are in red. So it basically just like inflation. Inflation में क्या होता है कि we take the necessities to calculate the inflations, right? Like flour, petrol, and these things, necessities of life. Likewise, there are more than 5,000 companies in the Indian stock market. We choose only top 50, that is a Nifty 50 index. They will, by seeing Nifty 50 index, we can say markets are running in the positive way or in the negative way. So Nifty 50 has a 50 stocks only, but after those 50 stocks, there are more than 5,000 companies also. So the stock market is basically Nifty 50 is a broad index. So journey to the 25,000 levels, we have seen that Nifty has started from 1,000 in 1995, and it took 9 years. It took 9 years to double 1,000 from 2,000. In 2004, it get to 2,000 mark. And after every, you see, last 1,000 points, we have reached in only 21 days, from 24 to 25,000. We have reached into less than 21 days. So as the market are approaching higher and higher, the number of days to you can say the returns are increasing day by day more quickly. So that in 2007, Nifty reached to 6,000 marks, three times in next 3 years, right? So we are seeing journey to the 25,000 levels, and we are now at 25,000. So we can say that in 30 years or 29 years, we have made 25 times our money. So how this money is being made? I met a trader. I met a trader in a seminar. He said, "I am watching Nifty from 1,000 levels, and till now I have not made even a single rupee from the market." So how is it possible? It is possible when you take care of your risk management, right? So you can see this calendar year performance in more than 4 calendar years. In 4 calendar years, Nifty has given more than 50% return. In 7 calendar years, more than 30% returns. And it has fallen two times, more than 20%. That is, one was the COVID and one was the 2008 recession. So market has given wonderful returns to those only who manages the risk. पैसा बनता है मार्केट के अंदर there is a lot of money in the market. It's like a sea, and you can collect the water as much as you want. It is like that only. If you have a risk management strategy in place, you can make unlimited money from the markets. See, there are a lot of events in the journey of from 1,000 to 25,000. There are a lot of events in between, change of government and some terrorist attack, some recessions period in US. You can say in 2008, there was a recession in global markets. Even after that, markets are at lifetime high. So we can take one observation from here that some people would have lost in these terrorist attacks, in these general elections when Congress won, the market rise very sharply. Then some corruption scandals, whenever they erupt in the markets, in the nation, the market tends to fall. Like in case of PNB Bank, it fell when Nirav Modi uh, fraud came in front. So economic policies, GST rollout. So market reacts on every news. There are ups and downs on the market. So, but ultimately the market has to go up. We can see we can see the sharp fall in COVID also, from 12,500 to 7,500. Nifty came back drastically. So now from 7,500, it is again 25,000. So who survived in those 2020, who survived, they will be making money. And who will survive? Those who will have the risk management in place. So market is a place where you can make unlimited money with the risk management. So risk management, you have to identify and assess the potential risks. What are the risks in the equity markets, and how to avoid those risks? Right. So there may be risk in many things. We have to take very much a lot of decisions in equity markets while trading and while investing. So there are a lot of risks. So first risk is, I will classify now. First risk is risk of stock selection. There are more than 5,000 companies in the Indian equity exchange, BSE and NSE both. So how you will identify which stock you have to buy? So there is a risk associated with the wrong stock selection. If you have selected a bad stock, you can say, if I will say, you have bought a Yes Bank, you have bought Yes Bank shares. So you have bought Reliance Communications shares. So what is the risk associated? Markets are going higher and higher, but your stock is not climbing even, and it is falling regularly. So there is a risk, and your money is on the stake. So you, being an intelligent investor, you have to take care of these 3 to 4 things, which I'll elaborate later on in my presentation. That some things you should know before entering into the, just like uh, entering into the markets. Just like you can take a use, there is a swimming pool, and you don't know the swimming, and you just get into the swimming pool. So there are a lot of chances you will not able to swim because you don't know the rules. So there's a market. People think, a lot of the people think that market will make, we will make money overnight in the markets. It is not like that. It is just a myth. So I will come to my first point. Which stock is to buy? Which stock? How you will select the stock out of those 5,000 stocks tomorrow? Which stock will have to buy? Which stock you have to avoid? See, there is an advance to decline ratio in every day's market. There are 5,000 stocks. 2,000 will rise and 3,000 will fall from the previous day's closing. So the advance to decline ratio tells you about the market, broad market trend, and maybe the market are 200 points plus Nifty or Sensex or Bank Nifty. Our indexes may be into 200 points plus, but more than 2,000 stocks will be falling on the same day. So there is a risk associated directly with the stock selection. How to select the stock? So one of the most important decision. I will come to this point then, that how to select the stock. First of all, I am just telling you ki what are the risks, right? So I'll come to later on how to select the stock. Then at what price? Second question is at what price? This is the second risk associated in the market. If you don't know, but at what price you should buy the stock. See, I have a Tata Motor share at 500 rupees, and someone else is having it at 250 rupees, right? So there is a gap of 250 rupees. Some person is having it at 250 rupees. I am having it at 500 rupees. The stock price is quoting at 400 rupees. The company is same, the investors are different. One is in profit. That guy who has taken the stock at 250 rupees, he is in profit of 150 rupees because the market price is 400 rupees. And one person who has bought this stock at 500 rupees, he is in loss. The company is the same. Company is working daily the same thing. So what made it one person is in loss and one person is for that? It's a price. At what price you have bought the stock. So this price is very important. So see, I have got a mobile of worth rupees to 20,000 rupees, for example. So I will tell anyone that buy this buy this mobile from me at 2 lakh rupees. Nobody will buy it. Why? Because that is not the correct price. Likewise, in the markets we see generally there are stocks, lot of stocks which are currently highly valued, but because they are rising day by day, valuations are very high valuations stocks are gotten. So people generally get tempted that buy this stock. This is called fear of missing out. So fear of missing out makes you make a bad decision. You buy the stock, and most of the times it falls after buying or after some days of your buying. So the second important point when you should where you should see that while investing the money, that if you have selected the stock, let's say you have selected Tata Motor stock. So now second question is when you have to buy it, at what price, at what price order. Would you buy it at current market price or wait for the correction if it has already taken a run? So it will get corrected and you have to buy it. You have selected that you will buy Tata Motors, right? So second important point is risk of uh, entering the stock at wrong price. So this is also a risk. Then third risk is the quantity risk. How much you will buy? If you have selected the Tata Motors, I will buy at 300 rupees when it will come. Right. So you have selected the stock, you have selected, you have chosen the price, right? Then if price came to 300, now third question, risk of buying the wrong quantities or heavy excess heavy quantities or less quantities. So third question is in how much quantities you have to buy the stock. This is very important, right? This is very important point. Sorry. There is a quotation we can say in the stock market that do not put all eggs in one basket. If I have a 1 CR rupees, 1 crore rupees, and I invest all the amount in Tata Motors, and there suddenly there comes a news that these engines will not be considered BS4, BS5, just like some negative news may come from the markets. So you will not be able to average your stocks. See, there is a difference between an investor and a trader. Investors are wedded to averaging, right? But traders are wedded to stop losses. I will come this point to later on. So third point, we were here. In what quantities I have to buy the so I don't want to deploy all the amount I have in my portfolio in one stock, single stock. So there is also a uh, risk of risk of asset allocation where you have to put one some amount in auto sector, some amount in pharma sector, some amount in metal sector, some amount in real estate sector, likewise some in banking and some in IT. So this is the risk associated that you may buy you may buy some inadequate quantities or less or more quantities. So this is also a question. And the most important fourth point is when to exit from one stock. Like IDBI Bank, it is not it is falling continuously. Like Yes Bank is falling continuously, and like Idea, Vodafone Idea. So when to exit is also important. For example, I take the same example. I had a stock at Tata Motors at 500 rupees, and someone else had the stock, Mr. A, I can say, at 250 rupees in my earlier example. But my risk management strategy said that you have to exit from this stock because it is falling continuously. So at 300 rupees, I take an exit and I take a loss of 100 rupees. So what happens to me? I got 300 rupees back. I invested for 500 rupees. So sorry, price was quoting at 400 rupees. I invested at 500 rupees. Price was quoting at 400 rupees. I took 100 rupees loss and I exited from the stock because my risk management strategy said that please exit from the stock. You have taken enough loss. The stock price is already falling. So get into another stock. Mr. A, who has bought the stock at 250, is still in profit at 400 rupees. So the stock price falls to, you can say, 150 or 200 rupees below the stock price of Mr. A. When Mr. A did not have any risk management strategy and he was in profit also, right? So when to exit is a very important point. I exited from the stock at 400. I invested it somewhere else and I got the returns there. So exiting from the stock is also a very important thing. So this fourth risk is that we do not know the exit. We do not know the exit from the stock. We keeps on averaging without any knowledge. We keeps on like I will say Vodafone Idea, Yes Bank, I have already told. So some stocks are there, Suzlon, Reliance Communication. There are a lot of stocks which have now very less value, and people have a lot of in lot of numbers those stocks just waiting for their price to come up. So these are the things which you should know before the buying. That I will repeat: which stock to buy, at what price, in what quantities, and when you have to exit the stock. One point more is there, that when you have to re-enter the stock, if you have exited from one stock. See, if you have exited from one stock and you want to buy again at lower levels, when to buy again? This is also so. Basically, people see the markets as a uh, without any base. I have seen many traders, many investors that without any base, they will buy the stocks on the basis of some tips from Telegram channel, WhatsApp channel, Instagram, social media. So this is not going to do good in your portfolios until and unless you have some risk management strategies in place. So coming over to next slides, uh, we should check ourselves actually, since it is our money. So we should check on ourselves that whether we are a trader or we are an investor or we are a compulsive investor. Because when I was a trader, I took a trade, but now it is down. I have become investor in that. So I will be called as a compulsive investor. With nature, I am a trader, but I am an investor because of the my poor risk management strategies. My stock has stuck. I have not taken a stop loss, and now I am an investor. Whenever the stock will climb, go above my price, then I will sell. So we should classify our role. We are a trader or an investor, because the risk management strategies goes different with the different roles. Earlier I was saying you that investor are ready to, they have taken a long term view. Investors are a long term view, have already have a longer long term view. But traders, what are the traders? Traders think of minutes and investor thinks of years. So if you are a trader, don't be an investor. And if you are an investor, then don't be a trader. If you are an investor, you have taken some stocks for long term. See, nowadays we are seeing the green energy stocks are rising very fastly, very sharply. So, since we are investor, we need not to check prices daily. We are a long-term investor. We should hold our holdings and we should sit tight. So, as a trader, I will not sit tight. I will regular trade. So my risk management strategies will be different. I will take decisions very frequently. In investing, I will uh, churn my portfolio in a month or in a 2 months time. So, but traders do these things in minutes, matter of minutes. So first of all, you should classify yourself as a trader and investor. Some people I have met, they have one separate trading account and one separate investment account. That can also help. So you should first check yourself whether you are a trader or an investor. Then only you will deploy your risk management strategies in the markets. So risk management, I say in trading, first of all, we should keep a strict stop loss on that, because we are a trader. We have some uh, arrows in, you can say, हमारे पास कुछ शस्त्र हैं वो लिमिटेड हैं. Those are limited. So we will not waste all the arrows. We will keep some stop loss. हम कहीं रुकेंगे जाकर. Just like I will say, I got one example, like in Mahabharata, Pandav and Kaurav, they were playing the games. So the Pandav did not kept any stop losses. So उन्होंने सब कुछ दांव पे लगा दिया. That uh, everything they had, they put it on stake. They lost everything they lost. So we should learn that stop loss is very important. When you will not have a capital, how will you take the next trade? This is, I am talking about the trading. So risk management, first point is how to manage your risk. It's, you have to take your stop loss. There is saying that if you will not book a loss, small loss, you will soon book a mother of all losses, right? And this is very much true. When a stock falls, it falls continuously. And if you have not taken a stop loss, that this will reduce your further trading capabilities. You will not be able to trade in next trades because you have lost capital in one trade. I've seen many traders, they trade very good. Their success rate is very good. So 90% out of 10 stocks they buy, nine are in profits and one is in loss. And that one loss is covers all the profits of all those nine trades, and the overall portfolio is in negative. So why one stock? See, a farmer grows the crop. There are some weeds also. They grow simultaneously. Farmer does not cut the crops. He cuts the weeds. Weeds are our bad stocks. We should keep on adding our good stocks which are giving profits. So generally, people have a tendency that we have to book our profits in those profit giving stocks, and we have to average those loss making investments. This is totally complete. If we will just do the inverse, we will see our profits will get doubled from earlier. This is very effective and very true that do not give water to the weeds. Cut the weeds and give water to the your crops. The crops will flourish. There will be more fruits. If you will cut your crops and weeds, it will keep watering the weeds. What will grow? Nothing will grow. You will get no fruits. So the point behind this is that if you have a portfolio, bundle of portfolio, you have 10 stocks, then do not cut your profit making stocks. Cut your loss making stocks. Take some stop losses. That is a better idea of managing your risk. See, risk is from the investment which is continuously falling, and we just keep on averaging that only. So we are not doing the right thing. So stop loss is very important just to save our capital, and we should have enough capital to do the next trade. We should not invest all the capital in one trade. There are some risk. These are some risk management strategies that you keep when you take a trade. You keep a stop loss of 2% of your capital. For example, I'm saying if you have 100, you have put in 100 rupees. So 2% of your total capital, 2% of your total capital should be a risk. So you can trade 50, you can take 50 trades from them. So keeping stop loss is very important. That is what I want to say. You should know your stop losses, where you have to exit from one stock, your tolerance power. Second point comes risk to reward ratio. See, risk to reward ratio. What is risk to reward ratio? I will not put my money on a stock if I will put 1 rupees at risk only if there I see 3 rupees of reward. So if this is risk to reward ratio is 1:3. So 1:3 risk reward ratio. If we go with these ratios, I will put 1 rupee at stake only when I can see that I am able to get 3 rupees as a reward. 1 rupees as a risk and 3 rupees as a reward. So this will make a good combination. I will show you with an example like risk to reward ratio in my this current slide. Risk to reward ratio, I have taken 10 trades. I have taken 10 trades, and in every trade, see, I have put you will able to see the importance of stop loss in this slide. Why stop loss is so much important? I am taking risk of 1 rupees for the reward of 3 rupees, right? So if I get wrong, my stock selection may be wrong. The first step, my stock selection may be wrong. Maybe I bought the stock, and next day some news came of war, or some news came of uh, weak economic data, GDP data, maybe any news, recession news. So market did not react according to me, and I took a stop loss. So there is a risk of 1 rupee. And for the reward, since I am selecting the stock on some basis, right? So I will be selecting those stock, trading those stocks where I can get 3 rupees in reward and I will put 1 rupees at risk. So if 1:3 is the risk reward ratio and my first stock hits the target, I get 3 rupees. My profit is 3 rupees. So the next trade I took, it took a stop loss and it took 1 rupee from me. So 50-50 is my success rate till now. I have taken two trades and one trade is correct and one trade is wrong. So I have lost 1 rupee and I have made a profit of 3 rupees on uh, first stock, right? So I have got a 2 rupees profit, even if I am at success rate of 50-50%. Now third trade I took of HDFC Bank and it hit the target. I got 3 rupees again. So this is my profit. And then next two trades I took, I got lost. So just like that, I see I have got only first trade right, then third trade right, and then sixth trade right. Only 3 out of 10, only three stocks out of 10 gave return according to me. So what does this indicate? I got 9 rupees. I got 9 rupees of total net profit, and I lost 1 rupee each trade because risk I have taken of 1 rupees. I have taken a stop loss. So I have taken a stop loss in 7 trades. I have lost 7 rupees. But in 3 trades, I got 9 rupees. So at the end, out of 10 trades, my success rate is only 30%. Out of 10 stocks, my 3 stocks are in profit and my 7 stocks are in losses. I have cut that losses. So what will happen here? See, stop taking stop loss. Uh, Still, when 30% is my success rate, I have got 2 rupees profit. So this is the significance of taking stop losses in the market. You will get many trades. You will get unlimited trades. There are more than 5,000 stocks in the market. So what uh, but if one trade is not going in your direction, you just exit from that stock rather than waiting uh, for a long time. Or traders must not become the investor. Basically, my point is. So this is the risk reward ratio, and I request everyone to keep and maintain a risk reward ratio of 1:3 in all the trades. If you see there may be a 3 rupees profit after on taking 1 rupee risk, then only enter into the trade, otherwise not. Some professional traders may be doing these things. So risk management, risk to reward ratio, I'll come back to another strategy, another risk management measure, I can say, that is leverage control. Leverage control. Leverage is basically leverage. I can define leverage that I have 1 lakh rupees in my demat account. I'm taking a position of 5 lakh rupees, 5 times than my capacity. So if 5 lakh rupees, I've taken a position of 5 lakh rupees with the margin money of 1 lakh rupees. What will happen if the stock fell 5%, or I will say 10%? That is quite possible. 10% stock falling of a stock of 10% at 10% is quite possible. We see many stocks, like we can see Paytm, we can see Paytm and the stocks which are trading in future and options. On result, if some companies declare poor result, it opens on lower circuit. What will we will do if we have a leveraged position? If we have 1 lakh only margin money and we have taken a position of 5 lakh rupees and the stock falls by 10% in not in 1 day, in 2 days, 3 days, in a week, and we have not taken a stop losses. 5 lakh, 10% of 5 lakh is 50,000. Stock has fallen 10% only, and your 50% capital is wiped out in one trade. This is very blunder. We have already seen, there is saying that future and options where leverage is given by the exchanges, markets, it is the world's most dangerous weapon. Future and options I'm talking about. So leverage should be in control. You should not take excess. You should keep your positions in your limits, and not just like that I want to get rich very fast, overnight rich. So there is no shortcut. There is no shortcut to make money in the markets. You have to be you have to be disciplined. You have to take control of your leverage positions. So this is true that if stocks climb 10%, then your capital will get 1.5 times. You will get 50% return on your capital. But the market does not always goes in our direction. So risk management is very important. Uh, but the second, fourth point, I will come to the fourth point is you should always have an emotional control. I've seen many traders, many investors that they don't cut their shares. If one stock has made profit for them, they will always buy that stock. For example, Reliance Industries. I met one investor. He says Reliance has never given me a loss. And one stock, Gujarat Gas, it has never given me a single penny, always taken from me. So these are the all the emotional things. You should not think like that. For example, I got a loss in Reliance Industries. I got a loss in I bought it at 2000 rupees. Now it is trading as at 1800, right? I booked my loss of 200 rupees and I took back the 1800 and I will invest it anywhere else. So the point is, don't get emotional with Reliance Industries because it has given you a loss. And you have no compulsion to do profit from Reliance Industries only. You have Reliance Industries has given me the loss. I will recover from the stock of Reliance only. This is not the way. You can put your money in some other stocks, say Bajaj Auto, Hero Motors, Maruti, like that, TVS. So these are the emotional things that we do in the markets generally. Most of the people do that. They tend to get profit from the stock which has given them losses. This is called the revenge trading also sometimes. This is a revenge trading. We should 100% avoid this. You have gone wrong. Accept, don't get in ego, accept it and put your money somewhere else. There are a lot of opportunities because there are more than 5,000 stocks in the market. So these emotional things, sometimes people say that this stock give me profit always. So I will invest in this stock. And so these are the emotional things. We should avoid these things. One profit may not be next time the stock will give you profit, but we are emotionally attached. There is a sell signal on the stock. Sell signal may be technical on the basis of technical analysis or fundamental analysis, but some due to some emotions attached to that stock, right? So people are not able to sell the stock even when it is falling. So when there is an exit signal, in my fourth point of risk management mistakes that we do, that we do not know when to exit. And when there is an exit signal, we do not actually exit from the stock. So this is the do not get emotionally attached to any stock. Nobody will come to your home and give you the money back if you lose the stocks, lose the money in the stock. So this is emotions you have to take control. And in trading, it is very difficult. It is very difficult uh, to control the emotions, but it is very important also. So the trade management, next point is trade management. How the traders manage their trades. See, you don't have to, you have 10 lakh rupees, for example. You have taken 50 trades at a time. This is a poor risk management strategies that one stock you have taken, it is not going in your direction, in your desired direction. You got to see another trade which is rising. Stock is rising in the intraday. I'm talking about trading only, traders. So we took another trade. After 15 minutes, another stock. So we added a lot of stocks in our trade list. So This is not a good sign. This is a poor trade management. For example, I have taken 10 trades. I have taken 10 trades at one time. First of all, it is very wrong. You should not take many trades, more than I will suggest maximum 4 to 5 trades in should be in your trade list, not more than that. This is the risk management, because what will happen, I will tell you what will happen if you have taken one trade, it has gone wrong. You have not taken stop loss. It is mark to market is in negative, right? Now you took second trade to cover the first trade because you have capital. So you will take second trade. The second trade, the second trade gets into profit, but it has not yet covered the loss of first trade, right? So you are waiting. By the time you are waiting, the profit that was coming get erases. The stocks come down. Now you took the third trade. Third trade, now third trade comes into losses. Meanwhile, your first trade recovers. So you are getting profit in your first trade now, and third trade is in loss. So if you add a lot of stocks, some you will not be able to book the profits in the trades which are showing profits, because you will always wait that maybe this profit will increase and will cover all my losses, all the trades, losses of all the trades. That is very rarely going to happen. So a lot of trades at one time will confuse you. It will give you a paralysis effect, that you will not see. Paralysis is a common word. It is not a paralysis is when you are not able to decide what to do. One stock will be showing you a profit. You will not cut it because you want that stock to give more profits to cover all the other losses. So you will not be able to cut that stock. Meanwhile, any other trade will get into profits. Your earlier profit will get erased because the markets, the price are continuously moving. So this trade management, poor trade management, or always, or I can say 90% results into losses. So we should not take a lot of trades at a time simultaneously. Maximum 4 or 5 trades we should take. And the next sixth point is, I will say, the hedging. Hedging basically is taking the opposite position. Opposite position, like future and options. Those my friends who are doing future and options trading, they might be knowing. If you have a portfolio, you have a portfolio of the stocks. You have very good portfolio of the stocks, and you keep on adding. You are an investor. This point is also for the investors also. You if you know the hedging techniques, you're taking the opposite positions in the markets. You have a portfolio of like 1 CR, right? It is divided into 10 parts of 10 lakhs, 10 lakhs, 10 lakhs each, right? So when market gives a negative signal, see, Nifty index gives you a negative signal that market is going to correct. What will you do? You will hedge your positions. You will not sell because you are an investor. Investor will not sell your portfolio. Investor will not sell their portfolios. They just do hedging. Hedging is basically selling Nifty in place of your portfolio. If market will fall, you will get profit from the Nifty index. This is called futures, trading in futures. So, what I suggest that investors should do hedge very carefully, but traders who trade frequently, they always do hedge. You should always be hedged from your risk. It will reduce your risk in the markets, and you will get small returns, but you will not make losses in hedging. So basically, these are the risk management tools for some traders, that you should keep a stop loss also always. You should keep in mind the risk reward ratios. Your trade management should be in control. You should be emotionally disciplined. You should be in leverage. Your position sizing should be in in limits. And the last is hedging. So basically, what about investors? Investors should diversify your funds. I will tell one thing, that if you have 1 CR, like I earlier told, you take you make 10 buckets of 10 lakhs each, and please do not put your all the amount in one stock. Like I earlier said, do not keep all eggs in one basket. You make 10 baskets. You make 10 baskets and you just invest equal amount of money in every stock, right? Because I have seen many investors, they have bought a share for rupees 1 lakh only. And that 1 lakh rupees is giving 200% return. The money has become 3 lakh rupees from 1 lakh. And another stock, which is uh, in the negative, which is in the negative, has given negative return. They are holding it for 10 lakh rupees. Well, 10 lakh invested in a return in a stock which is giving negative return, and 1 lakh invested in the stock which is giving 200% return. So the overall portfolio will be in negative, right? So, but one stock is getting double. So this is the misappropriation, misallocation of stocks. So the best thing is to keep 10 baskets of 10 lakhs and deploy equal amount to every stock. When you will hit the targets, you clear that bucket. See, if 10 lakh invested in stock A, 10 lakh invested in stock B, likewise, then 10 stocks you have invested. I also suggest do not put all the money at all the time. You only fill the total eight baskets, right? So you will be having spare 20 lakh rupees with you in case you have to average any stock. So put equal amounts in all the stocks. So you will diversify your portfolio. Uh, you can put in metals, pharma, IT, separate and this automobile sector, oil and gas sector, energy sector, cement sector, real estate sector. So diversify your portfolio. That this will minimize your risk, because if one sector is not doing good, the other sector will take the command. Second point is regular portfolio rebalancing. You should rebalance your portfolio. See, if you have taken a stock, um, it got doubled, you should take out some stock some you should take out some of the profits back to your home and reinvest in some other stocks. Likewise, you can do regular portfolio rebalancing. And third point is hedging. I've already told you that if your portfolio if you have a portfolio and market, you see the market is falling, do not sell your portfolio. Just sell the Nifty equivalent to your portfolio value. See, if you have a portfolio of 6 lakh rupees, that is the lot size of one Nifty future approximately. So when market is falling, you should sell one Nifty future of 6 lakh rupees. It will hedge your portfolio, because your portfolio will go down when the markets will fall, but your sell of Nifty will give you profits from there. And that profits, when you will book, you can buy the stocks again at lower levels from there. So these hedging techniques can do some risk mitigation, some risk management for you. So with this, I thank you, and I am open for the questions if um, any participants. Over to you, Rahul sir.
Thank you, Bharat sir. It was a really great session about the risk management. Sir, I have some questions for you.
Sure.
Yeah. One of the participant has asked on which basis weight of a particular stock is decided in Nifty 50 index.
Basically, it is decided on the basis of market capitalization, right? If you have a stock like Reliance Industries, its market capitalization of all the stocks taken all together. See, market capitalization is a number of stocks of a company multiplied by the market price of the company. See, if for example, if See, if a company, let's say Reliance Industries Limited, it has 10 lakh shares. I'm just taking an example, and price of one share is 2,000 rupees. So it has become 2 crores, right? 20 crores. So this is Reliance market capitalization. Likewise, all the market capitalization will be done, and on the basis of that, weights will be given to each of the stock.
Okay, okay. Thank you, sir. Another question has came. Mutual fund is better than ETF. Is mutual fund is better than ETF?
So mutual ETF is of a specific like in there is a Nifty ETF. It will be invested in the only the ETF or more or less ETF you can trade daily on in your Demat account. ETF is better if you are a trader, but you are if you are an investor, long term investor, always uh, go for the mutual funds. You should go to for mutual funds. If you're an investor, if you're a trader, you should uh, more be inclined to ETFs.
Okay, sir. One last question. P ratio can be a parameter to assess valuation of a stock, and if so, more than 100 PE stocks are overvalued and should be sold.
See, PE ratio is very important aspect in fundamental analysis, basically. Right, there are two types of analysis: fundamental analysis and trading technical analysis. In fundamental analysis, we give a lot of weightage to the PE. If stock is earning 100 rupees per share, this is the earning per share of a stock. 100 rupees per share the stock is earning, and stock price is quoting at 4,000 rupees. So we have a PE of 40, right? So PE of 40, if the industry PE is 80, so we can say industry PE is 80 and our stock is undervalued. So we should check the PE of the stock and we should compare it with the PE of our industry, right? Of our peers. For example, Tata Motors, we should check PE of Tata Motors with the overall automobile industry. So if PE of overall industry is higher, then our stock is undervalued. And if PE of our stock is higher and PE of industry is low, then our stock is overvalued. See, PE is one parameter to judge the stock and not the solely decision taking parameter. So we cannot take decision on only on the base of PE. There are a lot of factors. Maybe the future expansion plans of the stock. The PE of that stock may be more than see Nika PE of Nika in some thousands. So if if a company like Zomato, its earning per share is in negative, for example, there may not be any PE, right? So PE is not a short formula to judge whether the stock is overvalued or undervalued. There are a lot of other factors also, but yes, more or less we can check if industry PE is higher and our stock PE is which we are doing research is lower, then certainly we are undervalued. We can invest in that stock on the basis of only PE. We should not invest. This is the one point.
Thank you, sir. Thank you, Bharat sir, for the wonderful information about risk management in capital markets. Now we will move on with the our second session. Second session is about recent case laws in arbitration, and this session for this session we have Advocate Sharvil Mujumdar as speaker. I'll briefly introduce him. He is a practicing lawyer in Gujarat High Court and Supreme Court since 2003. He's handling arbitration matters, NCLT matters, banking matters, commercial and constitutional matters. He has been a speaker on the topics like land laws, arbitration, law of drafting, pledging, and company law. So, will I'll ask Sharvil sir to take ahead this session.
Thank you,
Welcome, sir.
Rahul. Thank you, Rahul, sir. First of all, thank you for this opportunity to share some of my views on the recent case laws in the arbitration field given by various courts, including the Supreme Court. As chartered accountants, you will encounter several stages where arbitration would be involved. As chartered accountants, you come across various contracts, commercial contracts, financial agreements, as well as partnership deeds. And in all such documents and deeds, sometimes there are arbitration clauses. Most of the time, now disputes are being resolved through arbitration. And as chartered accountant, therefore, it becomes necessary to understand the nuances of arbitration law. So Arbitration Act basically provides a mechanism to resolve the dispute quickly. It is an alternative to the mechanism of resolving dispute through courts, because many times for commercial disputes, traditional courts take a very long time in resolving the disputes. And on the contrary, if you resolve to arbitration, then an arbitrator can decide the dispute much faster than what the traditional courts can decide. Also, the benefit of arbitration is that the challenge is on a very limited ground. So if an arbitrator has passed an award, then it can be challenged on a very limited ground available under the Arbitration Act. So today I intend to take you to various case laws, recent case laws which have been given in the past 1 year or so on various provisions of Arbitration Act. These case laws will help you understand better the implications of various situations which may arise where Arbitration Act is involved. So I'll just start this screen sharing. So yes, so the first case law which I would like to discuss today is a recent case law of NTPC versus SPML Infra, which is reported in 2023 Supreme Court cases online, page 389. So before I discuss this, let me give you some facts here. This is a case pertaining to the jurisdiction of a High Court or Supreme Court to refer the matter to arbitration. Now, the important point here is that under Section 11(6) of the Arbitration Act, the High Court has the power to refer parties to arbitration. So if there are two parties who have entered into an agreement or a contract, a commercial contract or whatever agreement, and it contains an arbitration clause, and if one party does not agree to appoint the arbitrator, the other party can go to High Court, and the High Court under Section 11, subsection 6 of the Arbitration Act has power to appoint an arbitrator. So in this matter, the facts were very interesting. In this matter, the facts were that SPML was complaining that it has not been paid the dues by NTPC. I am making the facts very basic for easy understanding. So SPML was disputing that it has not been paid fully by NTPC. NTPC ultimately paid certain amount to SPML. Thereafter, NTPC, despite paying that amount, retained the bank guarantees of SPML. So ultimately, SPML filed a writ petition before the concerned High Court, seeking a stay against the bank guarantees. In the writ petition, the parties entered into a settlement, and it was agreed that the bank guarantees will be released, and SPML withdrew the writ petition. It was further agreed between parties that the said settlement will be full and final settlement between the parties. So after this settlement, SPML invoked arbitration clause of the original agreement and sought to contend that this settlement has taken place by coercion, economic duress, and it is not agreeing to the settlement. It therefore requested the other side to appoint an arbitrator to decide the dispute, because it was then claiming some more amount than what was agreed as full and final settlement. The matter went up to Honorable Supreme Court. The Honorable Supreme Court said that such a dispute cannot be referred to arbitration, because once the parties have said that this is full and final settlement of the entire claim, then a party is stopped from then referring the dispute to arbitration. This is very important because Section 11(6) of the Arbitration Act has undergone a change in 2015. Prior to 2015, at pre-referral stage, the law was that the court, while referring the dispute, was required to see whether the dispute is barred by limitation, whether the dispute is arbitrable, whether there is a valid arbitration clause or not, etc. There were various cases which the courts were required to consider before referring the parties to arbitration. As you can see on your screen, the classes of cases were categorized into cases necessitating the court's direct determination on aspect of evaluating the existence and validity of arbitration agreement, cases falling exclusively under the jurisdiction of arbitral tribunal, and cases where court may opt to decide, especially those involving determination whether parties had finalized the contract or transaction by mutually satisfying their rights and obligation. So basically, if there was accord and satisfaction, then the matter may not be referred to arbitration. That is what the Supreme Court held here. In 2015, there was an amendment in section 11.6, as I said, and the amendment says that the court, while referring the dispute to arbitration, only has to consider whether there is a arbitrable dispute or not, and whether there is an arbitration clause in the agreement. So the 2015 agreement curtailed the powers of the court at the stage of referring the matter to arbitration and limited those powers to mean only in cases where there is no arbitration agreement, the matter may not be referred to arbitration. In all other cases where there is an arbitration agreement, the matter will have to be referred to the arbitrator. The arbitrator can thereafter decide whether the claim is justified or not, whether there was accord or satisfaction or not. So the Parliament brought in this amendment to specifically provide that the referring court, that is the High Court under section 11.6, only has to see whether there is an arbitration clause or not in the agreement. So in this matter, this particular amendment was interpreted by the Honorable Supreme Court, and the Honorable Supreme Court says that even after this amendment, the courts should have an eye of needle approach. These are the words used by the Honorable Supreme Court, that eye of needle approach has to be undertaken by the courts even at the stage of referring the matter to disputes for arbitration, even after this amendment. So eye of needle approach means that the court will have to see whether there is an arbitration clause or not. That is the primary requirement. And prima facie, the court will have to see whether the dispute is arbitrable or not. So if the dispute is patently false, patently untenable, then such a dispute may not be referred to arbitration. Even after the amendment made in section 11.6a of the Act, a dispute which is ex facie false, frivolous, ex facie time barred may still not be referred to arbitration in view of the law laid down by Supreme Court in this judgment. And that is called the eye of needle test, as mentioned by the Honorable Supreme Court. So in the facts of that case, the Honorable Supreme Court held that since there was a full and final settlement, and since the writ petitions were withdrawn by SPML, the dispute can no longer be referred to arbitration. So this is a very important judgment. The ordinary rule is that all disputes where there is an arbitration clause have to be referred to arbitration. But in this judgment, the Honorable Supreme Court, interpreting section 11.6a of the Arbitration Act, has held that if the dispute is patently frivolous, if it is ex facie time barred, if it is completely untenable, then the referring court can refuse the parties to go to arbitration. However, this is an exception to the ordinary rule, that ordinarily the referring court will have to refer the matter to arbitration, only subject to the just exceptions as mentioned by the Honorable Supreme Court in this judgment. The important thing here is that normally arbitration is also a very expensive process. Though it is very quick and less avenues for challenge of the arbitrator award as compared to the traditional decrees of the court, but at the same time it is very expensive also. So that is why the Honorable Supreme Court has carved out this exception. Also, one of the reasons is that ultimately a party should not be made to undergo the rigors of arbitration if the dispute itself is completely frivolous. So a party who has settled the dispute cannot then wriggle out of the settlement just like that and then say that the matter should still be referred to the arbitration. However, there may be cases, genuine cases, where the settlement may be due to undue influence, settlement may be vitiated by misrepresentation or coercion. So in such cases, the referral court can say that while I refer the dispute to the arbitration, all these pleas, whether the settlement was valid or not, are kept open and the arbitrator can decide such pleas. Now, if a party is referred to arbitration, the other party can still file an application under section 16 of the Arbitration Act, saying that the arbitrator cannot adjudicate upon the dispute. The arbitrator has no jurisdiction to decide this dispute because there has been a full and final settlement, or the dispute is time barred, etc., etc. So that power is still, even if the dispute is referred to arbitration, it does not mean that the dispute is valid. The arbitrator who is appointed to adjudicate upon the dispute can still consider whether the dispute is frivolous or not, whether the dispute is arbitrable or not under section 16 of the Arbitration Act. So the arbitrator can in fact rule on his own jurisdiction, and therefore many times referring courts say that all these pleas are kept open and the arbitrator will decide this while he decides the main matter. Now I may come to the second judgment, which is Larsen Air Conditioning and Refrigeration Company versus Union of India, 2023 SCC Online, Supreme Court, page 982. So this was a matter covering section 34 of the Arbitration Act. So I may give a brief outline as to what is section 34 of the Arbitration Act. Section 34 of the Arbitration Act is a provision by which an award of arbitrator can be challenged before the competing court. The competing court would be either the district court or high court, depending upon the original jurisdiction of a respective state. So under section 34, an arbitrator's award can be challenged. However, it can be challenged on very, very limited grounds. One of the grounds is the arbitrator's award being patently illegal, or the arbitrator's award being completely without jurisdiction. For example, there are cases which are not arbitrable. For instance, a dispute regarding validity of a will cannot be made subject matter of arbitrator, because that can only be decided by a court having jurisdiction to decide validity of a will. It is a special court called the Court of Probate, which will decide whether the will is valid or not. Certain kinds of labor disputes are not arbitrable. Criminal disputes are not arbitrable. And in cases where the arbitrator has completely ignored the material on record and passed an award, that award can be challenged under section 34 of the Arbitration Act. So in the case on hand which I was referring to, the issue was that the arbitrable tribunal had granted around 18% interest to the claimant. The matter went up to High Court. Under section 34 of the Arbitration Act, the High Court or the District Court, as the case may be in that case, held that the interest given by the arbitrator of 18% was not fair, because as per the High Court was of the view that in view of the provisions of the new Arbitration Act 1996, 18% interest cannot be given if there is rate of interest specified. And the High Court reduced the rate of interest from 18% to 9%. So that, if you see on your screen, that was challenged before the Supreme Court. And the Honorable Supreme Court ultimately held that the High Court was not justified in modifying the award of the arbitrator. The High Court's view was that the arbitrator, after 2015 amendment under section 31(7) of the Act, he has power to grant interest even at the rate of 18%, even if in cases where there is no agreed rate of interest, the arbitrator has a power of granting rate of interest. The Supreme Court said that the scope of interference with arbitrator's award is very minimal. This is a very important ruling of the Supreme Court, because it says that on very, very limited grounds, the arbitrator's award can be challenged. Normally, if you go to a traditional court and a decree is passed, then the first appeal against that decree or order can be filed, and the entire proceedings continue in the first appeal. Everything can be looked into by the first appellate court. In case of arbitration, entire thing is not open. Only limited scope of interference is given to the higher courts against the arbitrator's award. And therefore, in this case, the Supreme Court set aside the order of the High Court, which had modified the arbitrator award, and said that ultimately the terms of the contract will govern the relationship of parties, and the arbitrator in any case is not powerless to grant interest, and ultimately the matter was accordingly disposed of. At this stage, I must say that this very issue has been referred to larger bench of the Honorable Supreme Court and is pending consideration of the larger bench of the Honorable Supreme. So that is as far as the power to give interest by the arbitrator was concerned. The next important recent case law of the Supreme Court is the judgment of Unibros versus All India Radio, which was reported in 2023 SCC Online 1366. So this was a case where Unibros had filed arbitration claim against All India Radio on the ground that there was a construction contract between the parties. Due to delay on the part of the other side, Unibros had to suffer a lot of loss. The project was initially set to commence on 12/4/90 in the facts of that case, but the construction finished on 31/10/1994. It was the case of the contractor that the delay was attributable to the other side, as a result of which its resources remained idle, and therefore it filed a claim for loss of profit. Now, this loss of profit was claimed on the ground that because of delay by the other side, most of the resources of the contractor or the constructing party remained idle, and it could not utilize its resources in other fruitful manner, and therefore there was a loss of profit. The arbitrator granted the claim of loss of profit. That order was challenged, and ultimately the matter went up to the Honorable Supreme Court, and the Supreme Court held that the claim of loss of profit cannot be made in isolation. A party will have to produce relevant evidence to show what is the actual loss of profit suffered by it. In this context of loss of profit, the Honorable Supreme Court cited the judgment of ONGC versus Saw Pipes Limited, wherein it was held that under Section 34 of Arbitration Act, an arbitrator award can be set aside if it is against the public policy of India. So against public policy of India would also include an award which is against the fundamental legal principles and which is in violation of natural justice or which is patently illegal. So regarding the conflict with public policy, the Supreme Court concluded that the award which does not follow the binding decisions and which does not take into consideration the evidence on record would be an award which cannot be sustained, and such award can be set aside by courts under Section 34 of the Arbitration Act. So while the scope of interference against an arbitral award is limited, in this judgment, the Honorable Supreme Court has reiterated that there are certain conditions under which the award should be set aside, and these are the conditions like patent illegality, award passed in violation of natural justice, an award which is completely divorced the settled legal position, which does not consider the binding judgments, etc. So such awards the Supreme Court termed as awards which are contrary to the public policy of India. There are cases where awards may also be set aside because the arbitrator was disqualified to decide the dispute. So certain disqualifications are attached to the arbitrator which are contained in the schedule to the Arbitration Act. And if the arbitrator was in fact, for example, he was having interest in the subject matter or he has not acted impartially, there is a violation of principles of natural justice while conducting the arbitration proceedings, then such awards can be termed as awards which are patently illegal, and such awards can also be set aside, albeit under the limited jurisdiction available to courts to set aside the awards under Section 34 of the Arbitration Act. The next important judgment is the judgment of Cox and Kings versus SAP India Private Limited. this is a very important recent judgment of the Supreme Court on the doctrine of group companies in the context of Arbitration Act. So before I take you to this judgment, let me first tell you the facts of this case. So in this case, Cox and Kings had entered into an agreement, a commercial agreement with SAP India, where I'm broadly giving the facts, not sticking to the exact fact, but broadly, that in that agreement, it was an agreement for some software upgradation, and there was a dispute. Now, as per the facts of the case, the agreement, Cox and Kings case was that it had entered into an agreement with SAP India, the principal company, but it was dealing with various other group companies of the other side when the services were rendered, and ultimately the dispute had arose. So it went to the matter ultimately went to the Supreme Court because Cox and Kings also wanted to sue the other group companies under the Arbitration Act. Now, this is very important to note that, as I said earlier, that arbitration is a creature of a contract or an agreement. It is, though it is contained under the statutory provisions of Arbitration Act, arbitration will otherwise be governed by the terms of the contract, the terms of the commercial agreement which the parties have entered into. So here, Cox and Kings wanted to sue even the group companies of SAP India on the ground that it was also dealing with those group companies, and therefore such group companies should also be permitted to be brought under the purview of the arbitration proceedings which it had initiated. The general law at that point of time was that only signatories to the arbitration agreement will be governed by the arbitration proceedings. A non-signatory or a third party cannot be made to undergo the arbitration proceedings. That is the general rule. The argument here was that though the signatory is of course liable for or is required to participate in the arbitration proceedings, signatory to the agreement, but certain non-signatory group companies which are under the control of the signatory should also be made liable because there were dealings with those group companies. There were maybe exchange of communications, invoices, etc. with the group companies. And the group companies should also be liable for participation in the arbitration proceeding. That was the issue. So initially, Cox and Kings one judge, that is the first judgment came, wherein it was held that if the non-signatory is a part of single economic unit of the original signatory, then it is also liable or it has to then participate in the arbitration proceedings. So the ratio which was laid down was that the non-signatory will have to be a part of the single economic unit of the original signatory. Such a single economic unit is liable for arbitration or is required to take part in the arbitration proceeding even if it is a non-signatory. But then this came up for consideration again in another judgment, and the matter was thereafter referred to larger bench. And the issues were, I've mentioned in the screen, the first issue was that should the group of companies doctrine be read into Section 8 of Arbitration Act, or can it exist in Indian jurisprudence independent of any statutory provision? Whether the group of companies doctrine should continue to be invoked on the basis of principle of single economic reality. Whether the group of companies doctrine should be construed as means of interpreting implied consent or intent to arbitrate between the parties. And can principles of alter ego or piercing the corporate will alone justify pressing the group of companies doctrine into operation even in absence of implied consent? So these were the other larger issues. The matter was referred to 5 judges bench of the Honorable Supreme Court. And ultimately the decision came, which is now known as Cox and Kings 2, wherein it held that even if it is not a single economic unit, but even if the other non-signatory is part of the group company, then even such a non-signatory is required to be referred to arbitration to put a quietus to the dispute once and for all. So Honorable Supreme Court also noticed that these days in corporate structures, there are complex commercial transactions and the corporate structures may involve equity-based groups, joint ventures, informal alliances. There can be special purpose vehicles also in many cases. So all these are ultimately part of one single transaction. So a company may be dealing through its subsidiary, but if ultimately it is if the holding company, subsidiary company, or special purpose vehicle are all part of multi-corporate structure which are dealing with the same transaction with a third with the other party, then all these non-signatories can be referred to arbitration even if they do not form part of single economic unit. So that is Cox and Kings 2. And so on the screen, I have mentioned that the Supreme Court, upon extensive examination of the judicial precedents, summarized this, that the definition of parties would encompass both signatory and non-signatory. However, the actions of non-signatory parties may serve as an indication of their consent to be bound by arbitration agreement. So the non-signatory would obviously not have signed the arbitration agreement, but their actions would serve as implied consent. The stipulation of a written arbitration agreement will not preclude the possibility of binding a non-signatory party. And within the framework of Arbitration Act, the term party holds a distinct and separate meaning from the concept of persons claiming through or under a party to arbitration agreement. The Supreme Court further held that the principle of alter ego or piercing of the corporate veil may serve as foundation for applying the group of companies doctrine, and the group of companies doctrine possesses an independent standing legal principle considering section 2 and 7 of the Arbitration Act. And the court further held that single economic unit cannot be the sole purpose for binding a non-signatory. There are other factors which have been mentioned in this judgment. And ultimately, the Supreme Court held that the earlier view in chloro control, insofar as it says that group companies may not be bound, may not be the correct view. The important thing is the Supreme Court also stated that at the time of referring the parties to arbitration, this aspect, whether a non-signatory is bound or not, may not be gone into, and that the arbitrator can decide. As I said earlier, the High Court has a power to refer the parties to arbitration if the parties don't agree for resolving the matter through arbitration despite an arbitration clause. So while referring the matter to arbitration, the referring court may not go into detailed inquiry or evidence, because at that stage evidence is not to be led. So the referring court has to leave this question open to be decided for adjudication by the arbitrator, whether the non-signatory is part of the group company or not, whether the non-signatory is part of the single transaction which is in dispute. All this may require leading of evidence, and all these therefore are required to be considered by the arbitrator while he decides the main dispute. So whenever you have an arbitration proceedings where the issue comes up whether a non-signatory can be implicated as party or not, this Cox and Kings 2 judgment is a landmark judgment. It is a very recent judgment and has given clarity on many doubts which were prevailing with regard to reference of a non-signatory to arbitration. Now, the next legal issue which was also a burning issue was that what is the limitation for referring the parties to arbitration under section 11 of the Arbitration Act. Because as you know, under Limitation Act, the period of limitation for filing a suit, etc., is normally 3 years from the date on which the cause of action has arisen. So in case if there is a breach of contract and the party has not been paid the money or breach of any other terms of the contract, the period of limitation is 3 years from the date on which the cause of action has arisen. But the law was silent as to what is the period for filing application for referring the dispute to arbitration. Because there was some confusion and different courts had taken different views. Some courts had taken a view that for filing application under section 11 for referring the matter to arbitration, no period of limitation is specified, and that aspect can be decided by the arbitrator. The Honorable Supreme Court, in case of Arif Azim Company Limited versus Aptec, has clarified that even for filing an application under Section 11 of the Arbitration Act for referring the matter to arbitration, Limitation Act will be applicable, and if the dispute has arisen before 3 years of making this application, the referring court itself can say that the application to refer the dispute is time barred, and therefore it can refuse referring the dispute to arbitration. The bench of the Honorable Supreme Court has further clarified that limitation for filing an application under Section 11, which is for referring, would arise upon failure to appoint arbitrator within 30 days from the date of issuance of notice invoking arbitration. And the bench said that therefore the limitation period will be applicable, and if within 3 years you do not file an application for appointment of arbitrator, then the referring court itself at the threshold can dismiss the application for appointment of arbitrator. The next important issue of law which arises was in a recent judgment of the Honorable Delhi High Court. That is a judgment reported in the case of National Skill Development Corporation versus Best First Step Education Private Limited. The judgment is reported in 2024 Supreme Court Cases Online, Delhi 1479. The issue here was with regard to Section 29A of the Arbitration Act. So here I am referring to various judgments on various sections. If you see, first I refer to a judgment under Section 11, which is a referral stage. Then I refer to a judgment under Section 34, which is a case or a situation where the powers of the court to set aside arbitral order awards are concerned. Then I have referred to a judgment with regard to group of companies. Then I have referred to a judgment regarding Limitation Act. Now this is a judgment under Section 29A of the Arbitration Act. So before I explain this judgment, let me point out what Section 29A of Arbitration Act is. So under the new act, it means that under the amendment made in the Arbitration Act of 2015, a time limit has been specified for completion of arbitration proceedings. The time limit is 1 year from the date of completion of pleadings. The date completion of pleadings would be once you file a claim, the other side files a reply, you file a rejoinder, the pleadings are complete. So the act says that the arbitration proceedings have to be concluded within 1 year from the date of completion of pleadings. This is amendment which has come in 2015. Earlier there was no specific time limit for completion of arbitration proceedings. There were instances where arbitration proceedings had gone on. In fact, in one of the cases where I myself was involved as a lawyer, the arbitration proceedings continued for 8 to 10 years. So then it in fact does not serve the purpose of arbitration at all, because arbitration is meant for quick redressal or a quicker redressal than the traditional courts. If arbitration proceedings go on for 8 years, 10 years, then in fact it is not a substitute to the traditional courts, because then it is in fact as much as time consuming as the traditional courts take. But the amendment was made in 2015 that after completion of pleadings within 1 year, the arbitration proceedings have to be completed. However, Section 29A says that in a given case, if the proceedings are not concluded within 1 year, then with the consent of parties, the mandate of the arbitrator can be extended for a further period of 6 months. So the original period is 1 year for the mandate of the arbitrator, within which the arbitration proceedings have to be concluded. If within 1 year they are not concluded, with the consent of parties, the mandate can be increased for a further period of 6 months. Now, in case of a situation where even after 1.5 years, that is after further extension of 6 months, the proceedings are not concluded. In such a case, under Section 29A, the party can go to the court which has appointed the arbitrator or the concerned court having jurisdiction for extending the mandate of the arbitrator. And the court, in the facts and circumstances of the case, would extend the mandate of the arbitrator. The Honorable Delhi High Court in this case has said that there was a matter where it was a very interesting matter where though the mandate had expired, the arbitrator continued with the proceedings and passed an award. The High Court said was considering the question as to whether extension of arbitrator's mandate post delivery of arbitration award is maintainable or not. The Honorable High Court of Delhi was of the view that such an application for extension of mandate of arbitrator after the award is delivered cannot be filed. It was of the view that if the award is not delivered, the court can still extend the mandate. But if the award is already delivered, then naturally such an award will have to be set aside under Section 34 of the Arbitration Act. And the application to extend the mandate thereafter is not permissible. So in a case where the mandate is not extended and the award is not passed, and the court does not extend the mandate, the court may even substitute the arbitrator when the application under Section 29A is heard. And that would reflect badly on the arbitrator who is conducting the matter if the delay is attributable to him. So these days we find, and my personal experience also is that the arbitrators themselves see to it that the proceedings get over within 1 year or maximum 1 year and 6 months. In very rare cases, we are required to go to the courts for extension of mandate under Section 29A of the Act. Because otherwise there are even possibilities of arbitrator being blacklisted, etc., etc. So arbitrators don't give long adjournments, which is a very welcome move in my view. So it cannot, the arbitrators themselves see to it that the mandate is not expired, the proceedings continue expeditiously, and awards are passed. And which is a very welcome move because that is the real purpose and intent of Arbitration Act. You do not want the arbitration proceedings to continue going on indefinitely. You need a quick outcome. So this section 20, the provisions of the 2015 Act have really helped in achieving a quick resolution of the arbitration proceeding. So the next very important and very landmark judgment of the Supreme Court is the judgment in case of NN Global. So NN Global is a judgment in 3 parts. Earlier, it was a judgment by the 2 judges bench of the Honorable Supreme Court. It was thereafter referred, earlier it was a judgment by the 3 judges bench of the Honorable Supreme Court. It was referred to 5 judges bench, and then it was referred to 7 judges bench. So it's a very interesting case. I will give a brief history. So the dispute here was that in the NN Global 1 judgment, the dispute was that if an arbitration agreement is not properly stamped, whether the referring court can still refer the matter to arbitration or not. That was the dispute. The Supreme Court considered various judgments and ultimately held that if the stamp duty is not properly paid, it would not invalidate the arbitration agreement. The Supreme Court had taken a view that the arbitration clause in the arbitration agreement itself is a separate agreement. So even if the main agreement is cancelled or is terminated, the arbitration clause in the agreement itself constitutes a separate agreement by itself. And therefore, in the initial view of the Honorable 3 judges bench of the Supreme Court was that such a dispute at the referral stage can still be referred to arbitrator even if the document is not properly stamped. The matter was thereafter referred to 5 judges in another judgment, and then came the judgment of NN Global 2. So in NN Global 2, the 5 judges bench of the Honorable Supreme Court held that if the agreement containing arbitration clause is not properly stamped, the agreement itself would lack merit. So the majority view in the NN Global 2 case was that even if the arbitration clause is a separate agreement, the agreement requires proper stamp, and if it is not properly stamped, such a dispute cannot be referred to arbitration in absence of the agreement being stamped. The view of the Honorable Supreme Court was that such instruments are defective. On the basis of a defective instruments, the matter cannot be referred to arbitration. The view was further doubted, and then came the judgment of NN Global 3, which is a very recent judgment, wherein various important factors have been laid down, and ultimately the Supreme Court has held through 7 judges bench that even if there is a dispute about improper stamping of a document, even then, if the arbitration clause is there in the agreement, then that is all that the court has to see. Such agreements containing arbitration clause would be a proper agreement for the purpose of referring the matter to arbitration. The Honorable Supreme Court considered the issue of inadmissible documents and void documents. So, the Honorable Supreme Court said that even if the document is inadmissible as evidence, it may not become completely void. And the voidness of an agreement pertains to its enforceability, whereas inadmissibility focuses on whether the court can consider or depend on the agreement as a piece of evidence during legal proceedings. The Honorable Supreme Court considered what is the object of Stamp Act and what is the object of Arbitration Act. It held that object of Stamp Act is ultimately to generate revenue for the state, and objection of stamp would be a technical objection as far as referring the matter to arbitration is concerned, because the intent of Arbitration Act is to see that the parties resolve their dispute through arbitration process. The Supreme Court highlighted the modern needs of commerce and business efficiency and held that these have led to shift where authority of national courts is subordinate to the intentions of parties and competence of arbitral tribunal. And the Supreme Court held that the central aspect to the jurisprudence of Indian arbitration law is the principle of arbitral autonomy. And this principle empowers parties to an arbitration agreement to exercise contractual freedom, conferring upon the arbitral tribunal the authority to adjudicate the dispute that may emerge between them. So, it was further considered by the Supreme Court that the arbitration code or the act is a self-contained code in itself. And ultimately, the arbitration clause, as I said earlier, is also a severable clause in the agreement. And therefore, even if the main agreement is not properly stamped, the arbitration clause can still survive. And the referring court is duty bound to refer the matter to arbitration if it contains an arbitration clause, irrespective of the dispute of non-stamping or improper stamping. Another thing which is required to be noted here is that the issue of non-stamping or improper stamping is a curable defect. The document can always be later on impounded during the arbitration proceedings, and the arbitrator can direct parties to pay proper stamp duty on that. So in fact, there is a case where I am again involved as a lawyer in arbitration matter, where the other side has raised a grievance that the document of contract is not properly stamped. The learned arbitrator directed the parties to approach the stamp duty authority and directed the authority to determine proper stamp duty. So the parties went to the deputy collector, who was the concerned authority. He adjudicated the dispute and said that X is the amount of stamp duty leviable on this agreement. The stamp duty was paid. The document again became enforceable, and the arbitration proceedings continued. So even for such an issue, as you can see, a bench of 7 judges of the Supreme Court was constituted, and ultimately this issue was resolved, where there were some conflicts in the provisions of the Stamp Act and conflicts in the provisions of Arbitration Act. And ultimately the Supreme Court relied upon the doctrine of competence. So this doctrine of competence means that the arbitrator himself is competent to decide his own jurisdiction. The arbitrator himself, this is contained in section 16 of the Arbitration Act. So the arbitrator himself can decide whether the agreement is valid or not, whether he is having power to adjudicate the dispute or not, whether the agreement is properly stamped or not. All these issues are within the competence of the arbitrator to decide. And relying on the doctrine of competence, the Supreme Court held that ultimately the arbitrator can decide that the agreement is not validly stamped or improperly stamped. And at the stage of referring the matter to arbitration, this issue is not required to be gone into. And normal Supreme Court said that such agreements are not automatically void or unenforceable, and non-stamping is otherwise a curable, rectifiable defect. And ultimately, the conflict that was prevailing at that relevant point of time was resolved by the Honorable Supreme Court of India by the judgment of NN Global 3. Now, the next judgment which I would like to discuss today is the recent judgment of Bombay High Court. Honorable Bombay High Court. In arbitration, we'll find that there are a lot of case laws by Honorable Bombay and Delhi High Court. Apart from other Honorable High Courts, there are a lot of case laws of Honorable Bombay and Delhi High Court. And Honorable Bombay High Court recently, in case of L&T Finance Limited versus Diamond Projects, a case reported in 2023 SCC Online Bombay 2832, held. This was the case pertaining to Section 9 of arbitration. So this is another facet of arbitration, Section 9. So what is Section 9? Section 9 says that while the matter is being referred to arbitrator, if there is a need for urgent interim orders, then the parties can go to competent district court or high court, as the case may be, having jurisdiction, and ask for an urgent interim relief or an urgent injunction. Because many times, as you have seen from the earlier judgment, even for appointment of arbitrator, there are adjudications being taking place up to Honorable Supreme Court of India. So while the arbitrator is being appointed, because one party may not want the arbitrator to be appointed, may want to prolong the dispute. One party may want an early resolution of the dispute and may want appointment of arbitrator at the earliest. So while this dispute is being adjudicated, whether arbitrator should be appointed or not, and maybe it may take 6 months, 8 months to resolve that dispute. In the meantime, if there is an urgent requirement of any interim order, for example, if a party is going to lose possession of the property, or if the party feels that the partner could sell away all the assets of the firm and it would be left with no assets, even if the matter goes to arbitration, there would be nothing left. Then such a situation is saved by Section 9 of Arbitration Act, which says that even while the arbitrator is being appointed, the jurisdictional court can grant interim relief till the arbitrator is appointed. Now, the criteria for granting this interim relief are akin to interim relief or injunction which is granted by civil court under Section Order 39 of Civil Procedure Code, and where the courts will have to consider whether there is a prima facie case in favor of a party requiring injunction, whether balance of convenience is in favor of the party, and whether irreparable harm and injury would be caused to the party by not granting of injunction. In many cases, there may be situation of invocation of bank guarantee. So while the main matter may be referred to arbitration and it may take its time, a party can immediately go to the competent civil court or the high court under Section 9 and seek a relief of injunction against invocation of bank guarantee. Whether the injunction should be granted or not is a different matter, and that would depend upon the facts and circumstances of each case. In a given case, if the party seeking injunction is not able to make out a prima facie case, injunction may be refused. If the party is able to make out a strong prima facie case and is able to show that irreparable injury would be caused to it by not granting of injunction, then in such a case, injunction would be granted till the arbitrator is appointed. So once, for example, an injunction is granted and then by the civil court or the high court till the arbitrator is appointed, and thereafter the arbitrator is appointed, then for further injunction, because arbitration proceedings also take 1 year or 1.5 years or maybe more, depending upon the evidence involved, volume of evidence, etc. So during the pendency of arbitration proceedings also, the arbitrator has a power under Section 17 of the Arbitration Act to grant injunction. So Section 9 is ordinarily is restricted till the time the arbitrator is appointed and he takes up the matter for considering grant of interim injunction during pendency of arbitration proceedings. So section 9 is a power of injunction conferred upon court till the arbitrator is appointed. The language does not say till the arbitrator is appointed, but that is the ordinary practice. And once the arbitrator is appointed, section 17 comes into play and the parties can request the arbitrator to continue the injunction granted under section 9 or to give a fresh injunction till to preserve the subject matter of the property ordinarily till the arbitration proceedings are concluded. So this was a case where again the issue had come up that the instrument is not properly stamped and therefore injunction should not be granted. The Honorable Bombay High Court held that issue whether instrument is not properly stamped or not is not germane or relevant for the purpose of section 9 application. Section 9 application has to be decided on the parameters of balance of convenience, etc., which is akin to a power of civil court to grant injunction under Order 39 CPC. And ultimately, the Honorable Court, in the facts of that case, said that power of a court to grant relief under Section 9 is not limited because of the objection with regard to stamping or improper stamping of the document. And certain other principles have been laid down as to what are the criteria for granting injunction under Section 9 of the Arbitration Act. And it has held, the Honorable Bombay High Court held that for considering a relief under Section 9, the court cannot be stopped in its track if it is satisfied that the case has been made out by the petitioner for grant of interim relief. So Section 39 is only for the purpose of granting interim relief. It is not for the purpose of final relief, which ultimately the arbitrator will consider. Now, all these judgments are in fact lay down various principles and would require more detailed analysis, but I am just touching upon the main ratio laid down in the judgments because of paucity of time. Otherwise, each judgment may consume half an hour to 1 hour if one has to consider each judgment in detail. The last judgment which I would like to discuss today is the judgment of Avitel Post Studios, which is reported in 2021, volume 4, SCC 713. The issue here was that whether allegations of fraud can be adjudicated upon by the arbitrator and whether they require adjudication by a court. So the court, see, there could be cases where parties go to arbitration and one party alleges fraud or cheating or forgery. In arbitration proceedings, the arbitrator can even take help of experts. I mean, in case of a forgery, he can even refer the matter to a handwriting expert and determine whether there is forgery or not. But there can be cases which are in fact covered within the domain of a criminal law. The Honorable Supreme Court in the judgment of Avitel has held that in case of serious allegations of fraud, where the arbitration agreement itself is said to be vitiated by fraud, such cases cannot be referred to arbitrator. The arbitrator cannot decide such cases. For example, if a party says that the agreement which contains the arbitration clause itself is a forged agreement, then when there is an allegation of forgery of that very agreement, then naturally the arbitrator cannot decide whether the matter cannot be referred to the arbitrator. It should be decided by competent civil court. However, where there is a fraud which is not in the public law domain, for example, if there is a dispute between two partners of a partnership firm, one partner is bound to allege that the other partner has misappropriated the money of the firm, has cheated him, has sold the assets of the firm without accounting for them in the books of accounts. Then these are also allegations of cheating and breach of trust and fraud. But these are not fraud which completely nullify the arbitration proceeding. These are the aspects where there is a commercial fraud where the arbitrator can decide the aspect whether there has been cheating, fraud, misrepresentation or not. So this judgment carves out two exceptions, that where the fraud is of such nature where the arbitration agreement itself is vitiated by fraud, or where the allegations of fraud are so serious, which ultimately have to be dealt by criminal courts only, then such allegations of fraud are not arbitrary. The arbitrator cannot decide such allegations of fraud. Otherwise, ordinary allegations of fraud, cheating, which arise out of commercial transaction, etc., the arbitrator can certainly decide. And even if in a given case, criminal cases are pending for the very same dispute, even then the arbitrator has power to decide the dispute if it is not a criminal act which is, as I said, against public law, or which is of such nature which requires examination only by criminal law. So ultimately, if it is a fraud against public, then the arbitrator cannot decide. If it is an inter se fraud, the arbitrator can certainly decide. He can even take help of experts. So as I said, because of paucity of time, I might have to stop here because I was told that it is only till 6 p.m. These are just the general ratios laid down by the Honorable Supreme Court and other courts in recent judgments given in the field of arbitration. I have tried to cover different aspects, as I said earlier. And these judgments clearly throw a lot of light and clear a lot of controversy that was prevailing in certain issues, and have resolved various burning issues which were there and which arise during the course of arbitration proceedings. And I'm sure if these judgments are read in completely, then a lot of clarity would be there whenever you are faced with similar situation in course of arbitration proceedings. And if there are any questions to be considered, kindly let me know.
Hello, sir.
Yes.
It was a wonderful session. I just have one question. Can a chartered accountant be an arbitrator, and what will be the procedure?
Certainly, a chartered accountant can certainly be an arbitrator. In fact, in matters where there are disputes about accounts, where there are disputes arising out of financial agreements, it is in fact better that chartered accountants become arbitrators. There is no procedure. The parties can. It is ultimately arbitration is based on agreement between the parties. So, if parties agree to refer the matter or dispute to a chartered accountant can be an arbitrator. There have been cases which I have conducted where chartered accountants have been arbitrators. Similarly, in construction agreements, there have been cases where engineers have been arbitrators. So, in cases where complicated questions of law may not be involved, but questions of accounts, finance, etc. are involved, in fact, chartered accountants would make for better arbitrators. On a just further note, there have also been cases where arbitrator is a retired judge of a court and has sought help of chartered accountant in matters relating to accounts by appointing him as an expert. So even that is possible, where chartered accountant himself may not be the arbitrator, but his help as expert is sought for.
Thank you, sir. Thank you for this wonderful session about the recent case laws on arbitration. Today, it was a great learning as more than 325 participants were there to attend the session. This was a great learning for us. And with this, once again, I thank you, Sharvil sir, thank you, Bharat sir, and thanks all the participants. And with this, I declare that this session is concluded. Thank you, sir.
Thank you so much.
Thank you, sir. Thank you.
Thank you so much, sir.
Thank you.